Before we begin, please note that the information provided in this video is for educational and informational purposes only and does not constitute financial or legal advice. I am not a licensed insurance agent or financial advisor. Auto insurance policies, regulations, and pricing are complex and vary significantly by state, individual circumstances, and the specific insurance provider. Always consult with a qualified and licensed insurance professional to understand your specific needs and to obtain advice tailored to your personal situation before making any decisions. This presentation is an independent overview and is not sponsored or endorsed by the General or its affiliates. Picture this: you make one mistake. Just one. Maybe you were running late and got a speeding ticket, or you had a minor fender bender in a crowded parking lot a few years back. Or perhaps life got in the way and you let your insurance lapse for a few weeks. Suddenly, you're a pariah. Every time you get a quote from one of the big, friendly-sounding insurance companies, the number that comes back is astronomical. They treat you like you're a professional stunt driver. You feel trapped. You need insurance to legally drive to work, to pick up your kids, to live your life. But it feels like the entire industry has put a giant, flashing rejected sign over your head. This isn't a hypothetical scenario. This is the reality for millions of Americans. They're good people who've hit a bump in the road, and the system is punishing them for it with sky-high premiums they simply can't afford. It's this exact gap, this massive pool of underserved drivers, that allowed a company with a cartoon general and a celebrity basketball player to become one of the most recognized insurance brands in the country. We're talking, of course, about the General. And for the next 10 parts of this series, we are going to do the single most comprehensive, unbiased, and in-depth analysis of this company you will find anywhere. We are going to rip apart the marketing, dissect the policies, and uncover the truth. By the end of this, you will know definitively whether the General is the secret solution you've been looking for, or a financial trap you need to avoid at all costs. We're going to solve the problem of uncertainty and give you the clarity you need to make one of the most important financial decisions you'll make all year. So who are they, really? Beyond the commercials with Shaquille O'Neal, beyond the catchy jingle, what is the General? At its core, the General is what's known in the industry as a non-standard auto insurer. That's a polite corporate term. What it really means is they are an insurance company for high-risk drivers. They built their entire business model on saying yes to the drivers that Geico, Progressive, and State Farm often say no to, or quote a price so high it might as well be a no. What makes a driver high risk? It's a wider net than you might think. It could be a major violation like a DUI or a reckless driving charge. It could be a history of at-fault accidents. But it can also be things that feel less severe. Having a significant lapse in your insurance coverage, for instance, is a massive red flag for insurers. Being a brand new driver with no history at all can place you in this category. And here's the one that surprises most people: having a low credit score. Yes, in most states, insurance companies use a credit-based insurance score to determine your risk, and a poor score can catapult you directly into the high-risk pool, even with a perfect driving record. The General looked at this massive market of drivers being cast aside and saw an opportunity. Their mission wasn't to compete for the perfect driver with an 800 credit score and a spotless record. Their mission was to provide a path to legal, affordable insurance for everyone else. They specialize in something called In-State Route 22, which is a certificate of financial responsibility that a court or the DMV might require you to have after a serious traffic violation. For many drivers who need In-State Route 22, the General is one of the few, and sometimes only, options available. This is where the perception of the brand comes from. For years, the General has been seen as insurance for bad drivers. And while there's a kernel of truth to that, they do serve drivers with significant issues on their record. It's a massive oversimplification. They also serve young drivers, drivers with poor credit, and people who just need a basic, no-frills policy to stay legal on the road without breaking the bank. And let's talk about their marketing genius for a second, because it's key to understanding their identity. For years, it was the quirky, animated General. But then they made a brilliant move. They partnered with one of the most beloved and recognizable athletes on the planet, Shaquille O'Neal. But this wasn't just a random celebrity endorsement. It was a story. Shaq has openly talked about how, when he was a young, struggling college athlete at LSU, he used the General for his car insurance. The story positions the General not as a penalty box for bad drivers, but as a stepping stone. It's the insurance you get when you're starting out, when you're trying to get back on your feet, when you need a second chance. It's a narrative of redemption and practicality, And it completely reframed the brand's public image. It made them relatable. But a great story and a famous spokesperson don't tell you anything about the quality of the product. Is the coverage any good? How does their claims process work? Are their customer service reps helpful? Or will they leave you stranded? And the most important question of all, is it actually cheap? The answer to all of these questions is complicated. It's a mix of yes, no, and it depends. And that is exactly why we're doing this series. We're going to cut through the noise. We're not just going to read their marketing brochure back to you. We're going to dive deep. We'll explore every single type of coverage they offer, from basic state minimum liability that just keeps you legal, to the more comprehensive options you might not even know they have. We will break down their pricing structure and show you the hidden factors that can cause your rates to swing wildly. We'll look at real customer reviews, the good, the bad, and the ugly, to see what actual policyholders are saying about their experience when they actually have to file a claim. We'll investigate their relationship with their parent companies, American Family Insurance and Permanent General Assurance Corporation, to understand the financial stability and corporate structure behind the cartoon character. And finally, we will put them head-to-head with their biggest competitors in the non-standard insurance space, companies like Safe Auto, and even the non-standard divisions of larger companies, so you can see exactly how they stack up. This is your ultimate guide. Our goal is to arm you with so much information that by the time you finish this series, you won't have to guess. You will know. You'll know their strengths, you'll know their weaknesses, and you'll know if they are the right choice for your wallet and your peace of mind. The world of high-risk auto insurance is murky and confusing by design, but we're about to turn on all the lights. So, we know who the General is targeting and the story they tell. But what are they actually selling? What kind of protection do you truly get when you sign on that dotted line? The answer is far more complex than just car insurance, and it reveals the fundamental trade-offs you have to make when choosing a company like this. Let's start with the absolute bedrock of what the General and any other car insurance company sells. It's called liability coverage. And if you only remember one thing from this entire video, make it this: liability coverage is not for you. It does not protect your car. It does not pay for your medical bills. It does absolutely nothing for you directly. Instead, liability coverage is a shield. It's a financial fortress you build around yourself to protect you from the person you just hit. Because when you cause an accident, you are legally responsible or liable for the damage you've done. And that damage comes in two main flavors. First, there's bodily injury liability. This is the big one. This is the coverage that kicks in when you injure another person with your car. Think about it. A simple rear-end collision at a stoplight. It seems minor, but the driver of the other car gets out, rubbing their neck. A week later, you get a letter from their lawyer. Suddenly, you're on the hook for their emergency room visit, the MRI scans, the weeks of physical therapy, the wages they lost from being unable to work. If the injury is severe, you're talking about life-altering sums of money. Hundreds of thousands, even millions of dollars. Without bodily injury liability coverage, that money comes from you. It comes from your savings account, from the equity in your home, from your future wages. They can and will garnish your paycheck for decades. Bodily injury coverage is what stands between a bad day on the road and total financial annihilation. The second part of this shield is property damage liability. This one is more straightforward. It pays to repair or replace whatever you hit. The most obvious example is the other person's car. You misjudge a turn and sideswipe a brand new SUV. That's not a $500 body shop fix anymore. With modern cars packed with sensors, cameras, and complex electronics, a seemingly minor fender bender can easily run into the tens of thousands of dollars to repair properly. But it's not just other cars. You could slide on ice and take out someone's mailbox and a custom landscaped flower bed. You could back into a garage door. You could swerve and hit a city light pole. All of that is your responsibility. Property damage coverage pays for that, so you don't have to. Now, here is where the strategy of companies like the General becomes crystal clear. Every single state, with the exception of New Hampshire, legally requires you to have liability coverage to drive a car. It's the absolute bare minimum you need to not get a ticket, have your license suspended, or your car impounded. The General specializes in getting people this exact state-mandated minimum coverage and doing it quickly and affordably. This is their core product. They are, first and foremost, a gateway to getting legal. But this leads us to one of the most dangerous traps in the world of auto insurance: the state minimums themselves. You see, the government tells you that you have to have this coverage, and they set a minimum amount. For example, A state might require you to have what's called 25/50/25 coverage. That sounds like code, but it's simple. It means your policy will pay up to $25,000 for bodily injury to one person, a maximum of $50,000 for bodily injury for the entire accident if multiple people are hurt, and up to $25,000 for property damage. On the surface, that sounds okay. 25 grand is a lot of money, but let's play that out. You cause an accident, and the other driver needs surgery and a week in the hospital. The bill isn't $25,000. The bill is $85,000. Your insurance company, the General or any other, will write a check for $25,000. That's what you paid them for. Then they will wish you the best of luck. The remaining $60,000? That's your problem. The other person's insurance company and their lawyers will be coming after you personally for that 60 grand. The same goes for property damage. You total a new $40,000 pickup truck. Your state minimum $25,000 policy pays out, and you are on the hook for the remaining $15,000. So while the General is excellent at providing these state minimum policies, it's critical to understand that the protection you are buying is often paper thin. It's designed to satisfy the law, not to fully protect your assets in a serious accident. It's a trade-off. You get a low price and a legal car, but you also take on a significant amount of personal financial risk. Okay, so that's liability. That's the coverage that protects everyone else from you. But what about you? What about the thousands of dollars you have invested in your own vehicle? If you cause an accident, liability coverage does nothing for your car. You could have a $30,000 car that's now a twisted wreck, and liability coverage won't pay you a single penny. For that, you need two other types of coverage, which are often bundled together and called full coverage. The first piece of this puzzle is collision coverage. It's exactly what it sounds like. It pays to repair or replace your car when it is damaged in a collision with another object. This could be another car, a telephone pole, a guardrail, a fire hydrant, you name it. The key thing to remember about collision is that it typically pays out regardless of who is at fault. If you cause the accident, it pays. If someone else causes it, it can also pay, though your insurance company will usually try to get the money back from the at-fault driver's liability policy. Collision coverage is what fixes your car after a crash. The second piece is comprehensive coverage. This is sometimes called other than collision coverage, and it's for all the weird non-crash related stuff that can happen to a car. A hailstorm pummels your vehicle, leaving it looking like a golf ball. A tree branch snaps in a windstorm and crushes your roof. You hit a deer on a country road. Your car is stolen from your driveway. It's vandalized. Catches on fire. These are all things that comprehensive coverage is designed to handle. It's the act of God and bad luck insurance. Now, with both collision and comprehensive, there's a key concept you have to understand: the deductible. A deductible is the amount of money you have to pay out of your own pocket for a claim before the insurance company starts paying. For example, if you have a $500 deductible and the repairs to your car cost $4,000, you pay the first $500, and the insurance company pays the remaining $3,500. If the damage is only $400, well, it's not worth filing a claim because the cost is less than your deductible. You just pay for it yourself. You get to choose your deductible amount. A higher deductible, say $1,000 or $2,000, means you're taking on more of the initial risk yourself, so the insurance company will give you a lower premium. A lower deductible, like $250 or $500, means the insurance company is on the hook for more money sooner, so your premium will be higher. So, do you need collision and comprehensive? If your car is paid off and it's an old clunker worth maybe $1,500, you might decide to skip it. The cost of the coverage over a year might be more than the car is even worth. But if you have a car loan or you're leasing a car, the answer is almost always yes. In fact, your lender, the bank or finance company, will require you to have it. Why? Because until you pay off that loan, the car isn't really yours. It's their asset, their collateral. They are forcing you to buy collision and comprehensive coverage to protect their investment from being wrecked or stolen. So the General, like other insurers, offers these coverages. You can get a policy that just makes you legal with liability, or you can add on collision and comprehensive to protect your own vehicle. This is the next layer of the trade-off. Adding this protection will significantly increase your premium, often doubling it or more. You have to decide if the value of your car justifies that extra monthly cost. We've covered the big three: protecting others from you with liability, and protecting your car from crashes and chaos with collision and comprehensive. For many people, this is what they think of as car insurance. But this is where the story gets really interesting, because there are massive gaps in this protection. What happens if the person who hits you has no insurance at all? What about your own medical bills if you're the one who gets hurt? And what about all the little unexpected costs that pop up after an accident, like needing a rental car while yours is in the shop? These are the questions that separate a basic policy from one that truly has your back when things go wrong. And this is where the menu of options at a company like the General gets much longer. Let's peel back the layers of that menu, because this is where you go from just being legal to being truly protected. Think of it like this: liability coverage is for the other guy. Everything we're about to talk about, this is for you. This is the stuff that saves your car, your wallet, and your sanity. First up are the two big ones, the superstars of auto insurance: collision and comprehensive. They sound similar and people mix them up all the time, but they are your shields against two very different kinds of chaos. Collision coverage is exactly what it sounds like. It pays to repair or replace your car if you're in an accident with another object. Notice I said object. Most people think this just means another car. And yes, if you cause a fender bender, your liability pays for their car, but it's your collision coverage that pays for yours. But it's so much more than that. Ever been in a tight parking garage and misjudged the distance to a concrete pillar? That sickening crunch? That's a collision claim. Ever backed out of your driveway and not seen the mailbox that seemed to jump out of nowhere? Collision. Hit a nasty pothole that bends your rim and destroys your tire? Believe it or not, in many cases, that's a collision claim. It's the coverage for when your car makes contact with something it shouldn't, and it's your fault, or a situation where fault is unclear or irrelevant, like a single car accident. Without it, you're paying for those repairs completely out of your own pocket. That $4,000 repair bill for a moment of distraction? It's on you. With collision, you pay your deductible, maybe $500 or $1,000, and the insurance handles the rest. Now, if collision is your shield against accidents, comprehensive is your shield against, well, pretty much everything else. This is the acts of God and mayhem coverage. Think of all the ways your car can be damaged while it's just sitting there, minding its own business. A massive hailstorm rolls through and turns your car's hood into a golf ball. That's a comprehensive claim. A heavy branch snaps off a tree during a windstorm and lands right on your roof. Comprehensive. You're driving down a country road at dusk, and a deer decides to redecorate your front end. Comprehensive. What about crime? Your car gets stolen from your apartment complex parking lot. Comprehensive. Someone breaks a window to steal your gym bag. Comprehensive pays to fix the window. It covers fire, floods, vandalism, falling objects, and animal collisions. It's the coverage for all the unpredictable, non-driving related disasters that can befall your vehicle. For a lot of people, having both collision and comprehensive is non-negotiable, especially if you have a newer car or a car loan. In fact, if you have a loan, your lender will almost certainly require you to have both. They want to protect their investment, and you should too. Okay, so your car itself is protected. But what about you? What about the massive inconvenience an accident causes? This brings us to the next tier of options, the ones that feel like luxuries until the day you desperately need them. Let's start with rental reimbursement. Remember that question? Your car's in the shop for 2 weeks after an accident. The body shop is waiting on parts. How are you getting to work? How are you taking your kids to school? Ubering everywhere? That could cost $50, $60, even $100 a day. Over 2 weeks, you could easily be looking at a bill of over $1,000 just for transportation. Rental reimbursement coverage is designed to prevent this exact nightmare. For a few extra dollars on your policy each month, the insurance company will cover the cost of a rental car, up to a certain daily limit and for a certain number of days. For example, a policy might cover $40 a day for up to 30 days. It turns a potential 4-figure financial disaster into a minor inconvenience. You just show your claim number at the rental counter, and you're back on the road. And what about those moments you're not in an accident but you're just stuck? We've all been there. That sinking feeling when you turn the key, and all you hear is a sad little click. Dead battery. Or you're driving on the freeway and feel that telltale wobble of a flat tire. Or, in a moment of distraction, you lock your keys in the car. This is where roadside assistance comes in. It's one of the most common and affordable add-ons. Instead of frantically searching on your phone for a tow truck company and hoping you don't get price gouged, you just call the number on your insurance card. The General, like most providers, offers this service to dispatch someone to help you out. They can give you a jump start, change a flat tire, bring you a few gallons of gas if you run out, help you if you're locked out, or tow you to the nearest repair shop if the problem is more serious. It's a small price to pay for the peace of mind of knowing that no matter where you are in the country, help is just one phone call away. Now we're getting into the really important, but often overlooked coverages that deal with the most valuable thing of all, your health. Let's talk about medical payments coverage, or MedPay. In some states, a similar coverage called personal injury protection, or PIP, is required. But let's focus on the concept. This coverage is designed to pay for medical expenses for you and your passengers after an accident, regardless of who was at fault. That last part is the key. Let's say you're in an accident, and you and your friend in the passenger seat both have to go to the emergency room for a checkup. Health insurance might involve high deductibles and co-pays. And if the other driver was at fault, getting their liability insurance to pay out can take weeks or even months of investigation. MedPay or PIP bridges that gap. It can kick in immediately to cover those initial hospital bills, ambulance fees, or follow-up doctor visits, without you having to pay out of pocket and without waiting for the fault to be legally determined. It's a critical buffer that ensures you can get the care you need, right when you need it. But there's one last category of coverage that I believe is one of the most important things you can possibly add to your policy. It protects you from a scenario that is both infuriatingly common and financially devastating. This is uninsured and underinsured motorist coverage. Let's paint a picture. You're a responsible driver. You have good insurance. You've got your collision, your comprehensive, all the bells and whistles. You're sitting at a red light and suddenly, bam, you get rear-ended by someone texting and driving. Your car is seriously damaged, and you have a painful back injury that will require months of physical therapy. The police arrive, and you find out the driver who hit you has no insurance at all. They were driving illegally. Or maybe they have insurance, but it's just the absolute bare minimum coverage their state requires, say $15,000 for property damage. But your new SUV is worth $40,000. Their insurance will pay out its max, and you're left with a $25,000 gap, not to mention your medical bills, which are piling up. This is where you become a victim twice. Once in the accident, and again by the other person's irresponsibility. Without uninsured or underinsured motorist coverage, your only option is to sue the other driver personally. And let's be honest, if someone can't afford car insurance, they probably don't have tens of thousands of dollars in assets for you to recover. You'll likely never see a dime. But if you have this coverage, your own insurance company steps in and acts as the insurance company for the at-fault driver. They will pay for your car repairs, your medical bills, and even lost wages, up to the limits you selected. You are essentially buying protection for yourself against the millions of drivers out there who are breaking the law, or are simply not carrying enough insurance to cover the damage they could cause. It's not just an add-on. For many, it's an absolute necessity to truly protect your financial future. So you see, building an insurance policy is about more than just satisfying the law. It's about looking at your life, your car, and your finances, and building a personalized fortress of protection. From the big shields of collision and comprehensive, to the convenient safety nets of rental and roadside, to the critical medical and financial backstops of MedPay and uninsured motorist coverage. The General lays out this entire menu for you, allowing you to pick and choose the pieces that make sense for your specific situation. Okay, so we've built our dream policy with all these layers of protection. But now comes the big question. What's this all going to cost? And more importantly, how can we get that cost down? Because getting the right coverage is only half the battle. Getting it at the right price, that's the whole game. And the General has a whole playbook of discounts we need to break down. Let's start with the king of all discounts, the one that can often provide the biggest single percentage drop in your premium, the multi-car discount. This is straightforward, but its power is often underestimated. Insurance companies love customers who bring them more business. It's that simple. By insuring 2, 3, or more cars with the General, you're not just getting a small thank you. You're fundamentally changing your risk profile in their eyes. You become a more stable, more valuable, and statistically less risky customer. The savings aren't just a flat fee. It's a percentage off of several parts of your policy. So, if you and your spouse or partner have separate policies with different companies, you are almost certainly leaving money on the table. Combining them under one roof with the General is one of the fastest ways to see an immediate and significant price reduction. It's the low-hanging fruit of the insurance world, so you have to grab it. Next up is the paid-in-full discount. This one is all about cash flow and commitment. Insurance companies operate on managing risk, and that includes the risk of you not paying your bill. When you pay your 6-month or annual premium all at once up front, you completely eliminate that risk for them. No chasing monthly payments, no processing fees, no chance of a lapsed policy due to a missed payment. They reward you for this. It might feel like a big chunk of money to part with at once, but do the math. Calculate the total cost of your monthly payments, including any installment fees, versus the single paid-in-full price. Often, the discount is equivalent to getting half a month, or even a full month of insurance for free. If you have the cash available, it's a guaranteed return on your investment that you won't find anywhere else. Now let's talk about you, the driver. This is where your actions directly translate into dollars saved. The most powerful discount in this category is the good driver, or safe driver discount. The General, like most insurers, heavily rewards drivers who prove they aren't a liability. This usually means having a clean driving record for a set period, typically 3 to 5 years. No at-fault accidents, no major violations like a DUI or reckless driving, and few to no minor tickets. This discount is a testament to your consistency behind the wheel. It's the insurance company acknowledging that your past behavior is the best predictor of your future behavior. If you've been a safe, responsible driver, you deserve to pay less than someone who hasn't. This isn't a small token of appreciation. It can be one of the largest discounts available, sometimes slashing your rate by a significant percentage. It's their way of saying, "We trust you." For younger drivers who often face terrifyingly high premiums, the good student discount is an absolute lifeline. If you're a full-time high school or college student, typically under the age of 25, and you maintain a B average or a 3.0 GPA, the General offers a substantial discount. Why? Because the data shows a strong correlation between responsibility in the classroom and responsibility on the road. Students who are disciplined enough to get good grades are statistically less likely to take unnecessary risks, get into accidents, or file claims. To get this, you can't just say you're a good student, you have to prove it. You'll need to submit a copy of your report card or a transcript. It's a little bit of legwork for what can amount to hundreds of dollars in savings per year. And what if your driving record isn't perfect? What if you're trying to turn things around? That's where the defensive driving course discount comes in. By voluntarily completing an approved driver safety course, you are actively demonstrating to the General that you are committed to improving your skills and becoming a safer driver. These courses refresh your knowledge of traffic laws, teach you accident avoidance techniques, and make you more aware of potential hazards. The insurer sees this as a proactive step to reduce your risk, and they'll reward you with a discount that often lasts for 3 years. The cost of the course is usually a fraction of what you'll save on your insurance premium over that time. It's an investment in yourself that pays you back. There are also discounts based on who you are and the life you've built. The homeowner discount is a huge one. This might seem strange. What does owning a home have to do with driving a car? From an insurer's perspective, everything. Homeownership is a major indicator of stability and financial responsibility. It suggests you're more settled, more likely to pay your bills on time, and less likely to engage in high-risk behaviors. You don't even need to have your home insured with the General or one of their partners. Simply proving you own a home, condo, or even a mobile home can unlock this powerful discount. It's one of the most overlooked ways to lower your car insurance premium. The General also honors those who serve. They offer a military discount to both active duty service members and veterans. This is their way of recognizing the discipline, responsibility, and sacrifice associated with military service. If you have served or are currently serving, make sure you ask for this. It's a well-deserved benefit. And of course, there are the small, simple, no-brainer discounts. Signing up for automatic payments from your bank account or opting for paperless billing saves the company administrative costs, and they pass a small piece of those savings back to you. These might only be a few dollars a month, but why wouldn't you take them? It's free money for clicking a button. Now here is the secret. The real magic isn't in getting one of these discounts. It's in stacking them. Think of it like a combo multiplier in a video game. Each discount you add doesn't just add to the total, it multiplies the savings. You're a homeowner? Boom, discount applied. You have 2 cars? Bam, another discount stacked on top. You paid in full? How, a third one? You have a clean driving record and your kid is a good student? You keep stacking. A single discount might save you 10%, but 5 stacked discounts could save you 30, 40, or even more. The final price is a result of this complex equation, and your job is to load up your side of that equation with as many discounts as you possibly can. And this is critically important, especially for the General's core audience. Even if you need in State Route 22, you are not locked out of these savings. Having an State Route 22 requirement means your base rate will be higher. There's no way around that. But you can still apply almost all of these discounts to that higher base rate. You can still get the homeowner discount. You can still get the paid in full discount. You can still get the defensive driving course discount. These are your tools to fight back against that high premium and claw back some control over your finances. Don't ever assume that because you're in a high-risk category, you're not entitled to save money. You absolutely are. So how do you make sure you get every single discount you deserve? You have to be your own advocate. When you're getting a quote, or even when you're reviewing your existing policy, you need to be proactive. Have a checklist. Ask the agent directly. Am I receiving the homeowner discount? Am I getting the multi-car discount? What about the safe driver discount? Don't assume they'll be automatically applied. And be prepared to provide proof. Your home deed, your student's report card, your defensive driving certificate. Review your policy every 6 months. Did you recently get married? Buy a house? Did a ticket finally fall off your record? These are life events that trigger new discount opportunities. Getting the right coverage is the foundation, but mastering the discount game is how you build a policy that is not only strong but also affordable. It's how you take a standard one-size-fits-all premium and chisel it down into a price that is custom-fit for you. You've now got the playbook. You know the discounts, you know how to stack them, and you know how to ask for them. You've successfully engineered a lower price. But a low price is only half the story. The price is what you pay, but the value is what you get. And you only find out the true value of your insurance on the worst day of your life, the day you actually have to use it. What happens when you see flashing lights in your rearview mirror? When you hear the crunch of metal and the shatter of glass? That's when you have to file a claim. That is the moment of truth for any insurance company. How they handle that process, how fast they are, how fair they are, how helpful they are, is what truly defines them. And the general's claims process. That's a whole other story we need to uncover. So let's paint a picture. It's 5:30 p.m. on a Thursday. The sky is that bruised purple color right before a downpour. You're on your way home, thinking about dinner, maybe what you'll watch on TV later. The light turns green. You ease into the intersection. And then from your left, a flash of red and the sickening sound of crunching metal and shattering glass. Your world lurches sideways. The airbag, a dusty, violent pillow, slams into your face. Silence. Then the frantic beat of your own heart. Your car is wrecked. You're shaken, but you seem to be okay. The other driver is getting out of their car. This is it. This is the moment of truth we just talked about. You have the general. Now what? The first thing you're told to do, after ensuring everyone is safe and the police have been called, is to report the claim. The general, like most modern insurers, offers a few ways to do this. You can call their 24/7 claims hotline, or you can open their mobile app. Let's focus on the app because that's the experience they heavily promote. You pull out your phone, your hand still trembling slightly. You open the app, navigate to the claims section, and begin the process. It's designed to be straightforward. It asks for the date, time, and location of the accident. It asks for the other driver's information, their name, their insurance, their license plate. You'll be prompted to take pictures. Lots of pictures. The damage to your car from every angle. The damage to the other car. The wider scene of the intersection, the skid marks, the traffic lights. You upload everything, hit submit, and a message pops up. Your claim has been filed. A representative will be in contact with you shortly. And that's when the clock starts ticking. This initial step, the first notice of loss, is just the opening play. The next person you'll hear from is arguably the most important person in this entire saga. The claims adjuster. A claims adjuster is an investigator. Their job, officially, is to determine the facts of the accident, assess the damages, and figure out how much the insurance company, in this case, the general, is obligated to pay under the terms of your policy. It's a common misconception to think of the adjuster as being on your side. They aren't your enemy, but they aren't your advocate either. Their ultimate loyalty is to their employer, the insurance company. Their goal is to close the claim efficiently and, crucially, for the correct and often lowest justifiable amount. So the adjuster calls you. They'll sound professional, maybe even empathetic. They'll ask you to recount the accident in your own words. They'll ask if you're injured. They will record this conversation. Every word you say is now part of the official record. They'll take your statement, compare it to the police report they've requested, and look at the photos you submitted. They might try to contact the other driver and any witnesses. This is the investigation phase. And this is the first major friction point where customer experiences with the general can dramatically diverge. On paper, this process is supposed to be quick. In reality, customers report a wide spectrum of outcomes. Some say their adjuster was responsive, called back quickly, and moved the process along. Others describe a black hole of communication, voicemails that go unreturned for days, emails that vanish into the ether, being passed from one department to another. This is a recurring theme in complaints not just for the general, but for many insurers targeting the high-risk market. The administrative horsepower might not always match the volume of claims. They are built for low premiums, not always for white glove service. Assuming your adjuster is on the ball, the next step is damage assessment. They need to figure out how much it will cost to fix your car. The general will likely use a photo-based estimating tool. They'll ask you to submit more detailed pictures of the damage, which are then analyzed by a team of estimators, sometimes using AI, to generate a preliminary repair estimate. They will then typically recommend you take your car to one of their preferred or in-network repair shops. There's a huge advantage to this. It's streamlined. These shops have a direct relationship with the general. They can bill the insurance company directly, meaning you're often only responsible for paying your deductible out of pocket. The process is faster because the trust and the payment systems are already in place. But there's a catch. You are never ever required to use their recommended shop. You have the legal right to have your car repaired at any licensed facility you choose. If you have a trusted local mechanic you've gone to for years, you can take it there. The difference is that the process might be a bit clunkier. Your mechanic will create their own estimate, submit it to the adjuster, and there might be some back-and-forth negotiation on labor rates or the cost of parts. And that brings us to the great debate: OEM versus aftermarket parts. OEM stands for Original Equipment Manufacturer. These are parts made by the car company itself. A Ford-branded fender for your Ford F-150. Aftermarket parts are made by third-party companies. They are designed to fit and function just like OEM parts, but they are almost always cheaper. Insurance companies, especially those focused on keeping costs down like the general, will almost always specify aftermarket parts in their estimates for cars that are more than a couple of years old. Your policy language likely gives them the right to do this. If you insist on more expensive OEM parts, the general may only agree to pay the amount of the equivalent aftermarket part, leaving you to cover the difference. This is a critical detail many people don't understand until they're standing in the body shop, looking at an estimate with a shortfall. Once the estimate is approved and the parts are sorted out, the repairs begin. Meanwhile, if your policy includes rental reimbursement coverage, the adjuster will arrange for a rental car for you to use while yours is in the shop. This coverage has a daily limit and a maximum total limit, for example, $30 per day for a maximum of 30 days. If your repairs take longer, or if you need a bigger car than the daily limit allows, that extra cost is on you. Finally, the moment of truth within the moment of truth arrives, the payout. If your car is reparable, the general pays the body shop directly, less your deductible, which you pay to the shop. But what if the damage is so severe that the cost to repair it is more than the car is worth? This is when the insurance company declares the car a total loss. And this is where things can get contentious. The general doesn't owe you what you paid for the car. They don't owe you what it would cost to buy a brand new one. They owe you the actual cash value, or ACV, of your vehicle the second before the accident happened. ACV is essentially the market price for a car of your exact year, make, model, and condition in your local area, minus depreciation. The adjuster will use a third-party service that scours sales data for comparable vehicles to arrive at a number. They'll present you with this valuation and a settlement offer. This offer is often lower than what the owner expects. We all tend to think our car is in better than average condition. The general, like any insurer, is trying to pay the fair market value. But they aren't going to round up. You can negotiate. You can provide your own evidence of comparable sales or recent upgrades you made to the car to argue for a higher value. But ultimately, their valuation is the baseline. Once you agree on a number, they will pay you that amount minus your deductible. They then take possession of your wrecked car and sell it for salvage. So, when you look at the general's claims process from 30,000 feet, it follows the industry standard. They have a mobile app for filing. They use photo-based estimating. They have a network of preferred shops. They pay based on actual cash value. The system itself is logical. But the defining factor, the one that generates all the good and bad reviews, is the execution. It's the human element. It's the speed of the adjuster's response. It's the fairness of the valuation. It's the clarity of the communication. J.D. Power, one of the most respected names in consumer ratings, consistently ranks the General and its parent company American Family in the lower tier for claim satisfaction. This doesn't mean every single claim is a nightmare. It means that, on average, a statistically significant number of their customers walk away from the process feeling less satisfied than customers of other major carriers. The complaints often center on delays, poor communication, and lowball settlement offers. This is the inherent tension of their business model. To offer rock-bottom premiums to high-risk drivers, you have to control costs everywhere else. And the single biggest cost for an insurance company is paying out claims. So when you're in that terrifying moment sitting in your wrecked car, the policy you chose is about to be put to the test. With the General, you have a policy that got you on the road legally and affordably, but the process of making you whole again might require more patience, more persistence, and more self-advocacy than you might have bargained for. But we've only talked about the car. We've focused on bent metal, repair shops, and vehicle valuations. This is the simplest part of any accident. Things get infinitely more complicated and infinitely more serious when the damage isn't just to your vehicle but to your body. Or worse, to someone else's. What happens when there are medical bills? What happens when you're sued? This is where the real purpose of insurance comes into play, protecting not just your car, but your entire financial future. And understanding how the General handles liability and injuries, that's where the stakes are raised to a whole new level. Let's paint a picture. It's a Tuesday afternoon. The sun is glaring off the car in front of you. You're stopped at a red light, maybe you glance down at your phone for just a second. A notification, a text message, and in that split second your foot eases off the brake. You roll forward. It's not fast, just a gentle tap. But it's enough. That sickening crunch of plastic and metal. Your heart plummets into your stomach. You get out, the other driver gets out, and your simple fender bender is about to become a masterclass in why liability insurance isn't just a suggestion. It's the only thing standing between you and financial ruin. This is the core of what the General and any insurer really sells. Not peace of mind, not just a piece of paper in your glove box, but a financial shield. And the two most fundamental parts of that shield are bodily injury liability and property damage liability. Let's break them down using our little Tuesday afternoon nightmare. Property damage, or PD, is the straightforward one. You hit their car. Your property damage coverage is what pays to fix their car. Simple, right? The other driver's rear bumper is cracked. A taillight is shattered. Maybe there's a dent in the trunk. The body shop estimate comes back $2,000. If your policy has a $25,000 property damage limit, you're golden. The General pays the $2,000 minus any deductible on your end if you also have collision, and you move on. But here's the first trap. Many people, especially those seeking the absolute lowest price, opt for the state minimum coverage. In some states, the minimum property damage limit is as low as $5,000 or $10,000. $10,000. Look around you on the road today. The average new car costs over $45,000. What if that car you tapped wasn't a 10-year-old sedan? What if it was a brand new Tesla, a luxury SUV, or a work truck loaded with expensive equipment? That gentle tap could easily cause $10,000, $15,000, even $20,000 in damage, especially with all the sensors and cameras packed into modern bumpers. If you only have $10,000 in coverage, guess who's on the hook for the rest? You are. Your savings, your wages, your assets, they're all on the table. The General will pay up to your limit, and then their obligation is done. The rest is your problem. Now let's get to the really scary part. Bodily injury liability, or BI. The other driver, at the moment of impact, says they're fine, just shaken up. But a week later your phone rings. It's an attorney. The other driver is now complaining of neck pain, back pain, headaches. They've been to the doctor, they need physical therapy, maybe an MRI. They can't work. Suddenly, this isn't about a $2,000 bumper anymore. This is about medical bills, lost wages, and pain and suffering. Bodily injury liability coverage is designed for this exact moment. It's typically expressed as two numbers, for example, 25/50. The first number, 25,000, is the maximum amount your insurance will pay for any single person's injuries in an accident you cause. The second number, 50,000, is the maximum total amount they will pay for injuries for the entire accident, if multiple people are hurt. So if you hit a car with 3 people in it, your insurance will pay a maximum of $50,000 total, with no single person receiving more than $25,000. Now stop and think about that. $25,000. Have you seen a hospital bill lately? An ambulance ride alone can be thousands. A single MRI can be over $1,000. A few physical therapy sessions, doctor's visits, prescription meds. That $25,000 limit can be vaporized in a matter of weeks. And we're not even talking about a serious, life-altering injury. If the person you hit requires surgery or long-term care, that state minimum policy is less of a shield and more like a piece of paper. You could be facing a lawsuit for hundreds of thousands of dollars, a debt that could follow you for the rest of your life. The general will provide a lawyer to defend you, but again, they will only pay up to the limits of your policy. Anything beyond that is your personal catastrophe. This is the critical conversation to have when looking at a quote from the general or any similar company. They will absolutely sell you the state minimum policy because it's the cheapest and it makes you legally compliant to drive. But legal and protected are two vastly different things. Being legal just means you won't get a ticket. Being protected means you won't lose your house because of a moment's distraction at a red light. But let's flip the script. What if you're the one who gets hit? You're driving perfectly, following all the rules, and someone blows through a stop sign and plows into your driver's side door. It's clearly their fault. But as you're sitting there, dazed, waiting for the police, you find out the other driver has no insurance at all. Or maybe they have one of those bare-bones state minimum policies we just talked about, and your medical bills are already soaring past their tiny limit. Now what? This is where uninsured and underinsured motorist coverage comes in. It's often sold as an add-on, and frankly, it's one of the most important coverages you can buy. Uninsured motorist, or coverage protects you. It steps in and acts like the at-fault driver's insurance when they don't have any. It can cover your medical bills, your lost wages, your pain and suffering, up to the limits you select. Underinsured motorist, or is similar. It kicks in when the at-fault driver has insurance, but their liability limits aren't high enough to cover all of your damages. Your coverage bridges that gap. The general offers these coverages, and it's a crucial decision point. Skipping them to save a few dollars a month is one of the biggest gambles a driver can take. You're essentially betting that every single person you share the road with is a responsible, well-insured driver. And statistics tell us that is a losing bet. Nearly 1 in 8 drivers in the United States is uninsured. That's a terrifying number. Finally, there's one more layer of medical protection to consider, and it operates a little differently. It's called medical payments coverage, or MedPay, and in some states, personal injury protection, or PIP. Unlike bodily injury or uninsured motorist coverage, MedPay and PIP are typically no fault. It doesn't matter who caused the accident. If you have this coverage, it helps pay for your medical expenses and those of your passengers right away. Think of it as first response health insurance for a car crash. It can cover the ambulance ride, the emergency room visit, co-pays, and deductibles from your primary health insurance. It's designed to get you immediate care without having to wait for a lengthy fault determination process. In no-fault states, PIP is mandatory and is your primary source for injury claims, often covering not just medical bills but also a portion of lost wages and other expenses, regardless of who was at fault. The general provides these options based on state requirements and a driver's choice. It's another line item on the quote, another decision that balances monthly cost against potential disaster. So you've got property damage, bodily injury, uninsured motorist, and MedPay. You've built a fortress of coverage. You understand the numbers, the limits, the what-ifs. You've done everything right. The accident happens. You make the call. And this is the moment of truth. Because having insurance is one thing, but using it, navigating the claims process, dealing with adjusters, and actually getting the money you're owed, that is a completely different ballgame. It's where the promises on paper meet the harsh reality of the system. And how the general handles that process, that's where the real story begins. So let's pull back the curtain. When you file a claim with the general, or any insurer for that matter, you are no longer just a customer. You are a line item on a balance sheet, a potential liability. And the person on the other end of the phone, the claims adjuster, has a very specific job: to manage that liability and minimize the financial exposure for their employer. Their goal is not to make you whole. Their goal is to close your file for the least amount of money legally possible. Understanding this one single truth will change how you handle every interaction from this point forward. The moment an accident happens, a clock starts ticking. The first 48 hours are the most critical, and this is where most people make their biggest mistakes. You'll call the number on your insurance card, and you'll be connected to a claims department. The person on the other end will sound incredibly empathetic. They'll ask if you're okay. They'll express sympathy for your situation. This is by design. It's meant to build rapport and lower your guard. And then comes the first and perhaps most critical test, the recorded statement. They'll say something like, "Okay, for our records and to speed up the process, I just need to take a quick recorded statement from you about what happened. Is that all right?" Sounds harmless. Sounds like standard procedure. But this is the first major trap. You are not legally obligated to give a recorded statement right away, especially if you're shaken up, injured, or unsure of the exact sequence of events. Adjusters are trained to ask leading questions. So you were a little distracted right before the impact? You didn't see the other car until the last second? A simple "uh-huh" or "I guess so" can be interpreted as an admission of partial fault, which can dramatically reduce your payout, particularly in states with comparative negligence laws. Your best response is polite but firm. "I'm not prepared to give a recorded statement at this time. I will provide a written account of the accident after I've had a chance to collect my thoughts." This simple sentence protects you immensely. Next, the adjuster begins their investigation. They'll get the police report, they'll try to contact witnesses, and they'll contact the other driver. All the while they are building a case. Not necessarily a case for the truth, but a case for the version of events that cost their company the least. While this is happening, you need to be building your own case. Take dozens of photos of the accident scene from every conceivable angle. Get pictures of both cars, the debris field, skid marks, street signs, and even the weather conditions. If there are witnesses, get their names and phone numbers yourself. Do not rely on the police report to be complete. You are your own best advocate. Now let's talk about the damage to your vehicle. The General, like many insurers focused on the budget market, has a playbook for this. They will heavily encourage you, almost insist, that you take your car to one of their preferred or network auto body shops. They'll sell it as a convenience. They can start work right away. We have a direct billing relationship. The work is guaranteed. Here's the reality. Those shops have contracts with the insurance company. They get a high volume of business in exchange for giving the insurer deep discounts. How do they give those discounts? Often by using aftermarket parts instead of original equipment manufacturer, or OEM parts. An OEM part is made by the same company that built your car. It's designed to fit and perform exactly as the original. An aftermarket part is a copy, made by a third-party company. While some are perfectly fine, others can have issues with fit, quality, finish, and even safety. They might not crumple the same way in a future accident, or could have gaps that lead to rust down the line. The insurer saves hundreds, maybe thousands of dollars. You're left with a car that may not be repaired to its pre-accident standard. You have the legal right in most states to have your car repaired at the shop of your choice. Do not let them bully you into using their network shop unless you've done your own research and are comfortable with it. The next step in the playbook is the lowball offer. The adjuster will call you with their initial estimate. It will almost always be lower than you expect. It might not account for hidden damage that can't be seen until the car is taken apart. It will be based on the use of those cheaper aftermarket parts. It will be based on regional labor rates that might not reflect the rates of a high-quality shop in your area. They are counting on you being frustrated, wanting the process to be over, and just accepting the first number they throw at you. This is where you have to stand your ground. Get your own estimates. Take your car to 2 or 3 reputable independent body shops that you trust and ask them for a full estimate using OEM parts. When you present these estimates to the adjuster, they will almost certainly push back. They'll say, "We don't pay for that," or "That labor rate is too high." This is a negotiation. They are testing your resolve. You need to be prepared to defend the estimates from your chosen shops. This is where having a good relationship with your body shop is key. They can often help you by providing documentation and justification for why certain repairs and parts are necessary. This process of back and forth can be unbelievably draining. It's designed to be. It's a strategy of attrition. The insurance company has teams of people who do this all day, every day. You have a life, a job, a family. They know that the longer they drag it out, the more likely you are to just give in and accept a less than fair settlement. Customer reviews for the General are filled with stories of this very tactic. Delayed return calls, lost documents, constantly being transferred to different adjusters, so you have to explain your story over and over again. It's a deliberate friction designed to wear you down. The key to fighting this is documentation. After every single phone call with your adjuster, send a follow-up email summarizing the conversation. "Dear adjuster's name, per our conversation today at 2:15 p.m., You stated you would review the supplemental estimate from my body shop and get back to me within 48 hours. I look forward to your response. This creates a paper trail. It establishes a timeline. It proves you've been proactive, and it's invaluable evidence if you need to escalate the claim. Finally, if you do reach a settlement, the fight might still not be over. You have to be crystal clear on what exactly that settlement covers. Does it include a rental car? Does it cover diminished value, the loss in your car's resale value, now that it has an accident history? Most initial offers do not, and you often have to fight for it separately. The claims process is the ultimate test of an insurance company. It's where their marketing slogans about being on your side are put to the proof. With a company like the General, which competes primarily on price, the pressure to control claims costs is immense. Their entire business model depends on it. This doesn't mean it's impossible to get a fair settlement from them, but it does mean you have to go into the process with your eyes wide open, prepared for a fight, and armed with the knowledge of the playbook they're using against you. You have to be more organized, more persistent, and more patient than they expect you to be. But what happens when persistence isn't enough? What happens when they dig in their heels, refuse to offer a fair amount, or worse, deny your claim altogether? You're paying your premiums, you've held up your end of the bargain, but they simply say no. At that point, you feel powerless. But you're not. You have options, powerful ones that most people don't even know exist. And knowing how to leverage those options that can turn the entire game on its head. So let's break down these options, starting with the one you should always try first. It's the internal appeal. Most people hear appeal, and they picture a stuffy courtroom. But in this case, it's a formal process inside the insurance company itself. You are essentially telling them, your first-level adjuster made a mistake. I want a supervisor, a manager, someone with more authority and experience, to review this entire case from scratch. This isn't just resending the same email with the word "please" in all caps. This is a strategic move. You need to craft a formal appeal letter. In this letter, you don't just state that you're unhappy. You methodically dismantle their reason for denial. You reference the specific sections of your policy that support your claim. You attach every single piece of evidence again. The police report, the photographs, the repair estimates, the medical records. You organize it so clearly that a 5-year-old could understand it. You are creating a paper trail that shows you are serious, organized, and will not be easily dismissed. The key here is professionalism and precision. No emotion, no angry accusations. Just cold, hard facts laid out in an undeniable sequence. You state the facts of the incident. You state the coverage you paid for. You state their reason for denial. And then you systematically show, with evidence and direct quotes from your policy, why their denial is incorrect. You end the letter by clearly stating what you expect. A full reversal of the denial and payment of the claim, as per the terms of the policy you both agreed to. Why does this work? Because sometimes the initial denial is from an overworked, undertrained adjuster who is incentivized to close cases quickly. Getting a fresh set of eyes on it from a senior claims manager who has to justify their decisions to their superiors can completely change the outcome. They know that if their denial is weak, it won't hold up to outside scrutiny, which brings us to our next weapon. What happens when the internal appeal falls on deaf ears? The General or any insurer sends you back a letter doubling down on their decision. Now you escalate. You go outside the company. You go to their boss. And their boss is your state's Department of Insurance, or DOI. Every state has one. This is a government regulatory body whose entire job is to oversee insurance companies and protect consumers like you. They are the referees, and they have a very big whistle. Filing a complaint with the DOI is free. It's simple. And it is one of the most powerful things a consumer can do. Think about it from the insurance company's perspective. They are a massive corporation dealing with thousands of individual customers. They hold all the power. But when you file a DOI complaint, you are no longer just one person. You are now a data point in a government file. A state regulator is now officially looking over their shoulder. When the DOI receives your complaint, they don't just file it away. They are legally obligated to investigate. They will forward your complaint directly to a special department inside the General, a high-level compliance or legal department, not the regular claims adjusters. The insurance company is then required by law to provide a formal, written response to the state, explaining their actions and justifying their decision. Suddenly, they aren't just answering to you. They're answering to the government body that gives them the license to operate in your state. Insurance companies are terrified of getting on the bad side of the DOI. A pattern of complaints can trigger audits, investigations, massive fines, and in extreme cases, they could even lose their license to do business. That single complaint you file might not seem like much, but when added to others, it creates a pattern that regulators cannot ignore. The pressure this creates is immense. Often, just the act of filing a DOI complaint is enough to get an insurer to reevaluate their decision and suddenly find a way to approve your claim. It's a complete game changer. But let's say even that doesn't work. The company sends a response to the DOI that, for whatever reason, the regulator accepts. You're still at a standstill. You've tried the internal appeal, you've tried the government watchdog. Now what? Now you move into the realm of alternative dispute resolution. The two most common forms are mediation and arbitration. These sound complicated, but they're not. Mediation is basically a structured negotiation. You and a representative from the insurance company sit down with a neutral third party, a mediator, whose job is to help you both find a compromise. The mediator can't force anyone to do anything. They just facilitate a conversation to see if you can reach a mutually agreeable settlement. It's often faster and cheaper than going to court. Arbitration, on the other hand, is a little more formal. It's like a mini trial. You and the insurer present your cases to a neutral arbitrator or a panel of them, and they make a decision that is often legally binding. This means that whatever the arbitrator decides, that's the final word, and you typically can't appeal it in court. Some insurance policies, especially for things like uninsured motorist claims, have clauses that require you to go through arbitration instead of suing. You have to read your policy carefully to see if this applies. Both mediation and arbitration can be effective ways to resolve a dispute without the time and massive expense of a full-blown lawsuit. But they're not your final option. There is still one last resort. The one that strikes more fear into the heart of an insurance company than anything else. The nuclear option: filing a lawsuit. And not just any lawsuit. Specifically, a lawsuit for bad faith. This is a term you absolutely need to understand. Bad faith doesn't just mean the insurance company denied your claim. It means they denied your claim unreasonably and without proper cause. It means they failed to conduct a thorough investigation. It means they deliberately misinterpreted the language in their own policy to avoid paying. It means they knowingly used deceptive practices or put their own financial interests ahead of their legal duty to you, their policyholder. When you buy insurance, you are entering into a contract. They have a duty of good faith and fair dealing. When they violate that duty, it's called bad faith, and the penalties for it can be astronomical. This is where you stop sending letters and you hire an attorney who specializes in bad faith insurance claims. When a lawyer like this sends a demand letter on your behalf, it gets immediate attention. Because if your case goes to court and a jury finds that the general or any insurer acted in bad faith, they might not just have to pay your original claim. They could be forced to pay for your attorney's fees. They could be forced to pay for the emotional distress they caused you. And here's the big one. They could be hit with punitive damages. Punitive damages are designed to punish the company for their behavior and deter them from doing it to anyone else. These damages can be millions, even tens of millions of dollars, often far exceeding the value of the original insurance claim. The threat of a bad faith lawsuit and a massive punitive damage award from a sympathetic jury is the ultimate leverage. The cost-benefit analysis for the insurance company changes dramatically. Suddenly, paying your $50,000 claim seems like a brilliant financial decision compared to the risk of a multi-million-dollar verdict. They know this, and this knowledge, this final powerful option in your back pocket, is what truly levels the playing field. It transforms you from a powerless victim into a formidable opponent. But to wield this power effectively, you have to understand the person on the other side of the phone, the claims adjuster. Their motivations, their pressures, their tactics. Knowing their playbook is the key to writing your own winning strategy. So let's open that playbook. The first thing you need to understand is that a claims adjuster is not your adversary in the way a movie villain is. They are a professional, and their profession is to protect their company's bottom line. They manage a huge number of cases, often over 100 at any given time. Their performance is measured on how quickly and, most importantly, how cheaply they can close each file. Every dollar they don't pay you is a dollar saved for their employer. It's not personal malice, it's professional protocol. Your claim is a number on a spreadsheet, a liability to be minimized, and they have a finely tuned process to do exactly that. The game begins the moment you get that first call. It will come sooner than you expect, sometimes just hours after the accident. The voice on the other end will be the epitome of kindness and concern. How are you feeling? I'm so sorry this happened to you. We're here to help you through this. This is not a social call. This is strategy. It's called building rapport. They want you to see them as a friend, an ally in this confusing process. Because when you trust someone, you let your guard down. You talk, and that's precisely what they want. After the initial pleasantries, they'll make their first move. It's a classic, and it's devastatingly effective. They'll say something like, "To speed things up and make sure I have all the facts right, I just need to get a brief recorded statement from you. It'll only take a few minutes. Is now a good time?" Sounds so reasonable, so harmless. It is the single most dangerous trap you can walk into. A recorded statement is not for your benefit. It is a tool designed to be used against you. Its sole purpose is to lock you into a story right then and there while you're still shaken up, maybe on pain medication, and before you've had a chance to fully process the event. They are hunting for keywords, for inconsistencies, for any turn of phrase they can later twist to their advantage. Let's say they ask, "So what happened?" And you, being a polite person, say, "I'm so sorry, the whole thing was just awful." Bingo! They'll note that you apologized. In a negotiation, an attorney for the insurance company could argue that your apology is an admission of guilt. Or they ask, "What were you doing right before the impact?" You might say, "I think I was just glancing down to change the radio station." Bingo! They now have you admitting to being distracted. Were you hurt? Well, my neck is a little stiff, but I think I'll be okay. Bingo! You've just minimized your own injuries on a permanent record. Weeks later, when that stiff neck turns out to be a herniated disc requiring surgery, they will play that recording back and say, "But on the day of the accident, you said you were okay." Every word you say is being scrutinized for its potential to devalue your claim. They will ask you to speculate. How fast do you think the other car was going? Your guess, made under duress, can be used to contradict the police report or an accident reconstruction expert's findings later on. The adjuster's goal is to create a record that serves their interests, not yours. So what do? You use the magic words. When they ask for a recorded statement, you politely but firmly decline. You say, "I'm not comfortable giving a recorded statement at this time. I can provide you with a written statement once I've had a chance to gather my thoughts." Or even more simply, "I will not be providing a recorded statement." You are under no legal obligation to do so in most situations, especially when it's the other driver's insurance company calling. Even with your own insurance, you should be incredibly cautious. Delay it. Tell them you need to speak with an attorney first, even if you don't plan to. This signals that you are not an easy target. You are taking this seriously, and so should they. The next tactic in their playbook is the strategic use of time. They know you're in a tough spot. Your car is wrecked, you might be out of work, and medical bills are starting to pile up. They understand that financial pressure is a powerful motivator. So sometimes the best tactic for them is to do nothing. They'll delay. They'll tell you they're waiting on a police report that they already have. They'll say your file is being reviewed by a supervisor. They'll transfer you to a different adjuster, forcing you to start the story all over again. Each delay is designed to increase your desperation. They are waiting for you to get tired, to get frustrated, and to reach a point where you'll accept any offer just to make it all go away. The countermove to the delay game is meticulous documentation. You must become the world's greatest record keeper. After every single phone call with the adjuster, you immediately send a follow-up email. "Dear adjuster's name, this email is to confirm our conversation today. Date, at, time. We discussed A, B, and C. It is my understanding that you will be taking the following actions. I look forward to hearing from you by a reasonable date." This does two critical things. First, it creates a paper trail that prevents them from denying what was said. Second, it applies pressure. It shows them you are organized, you are serious, and you are building a file. Adjusters are less likely to play games with someone who is clearly documenting their every move. Eventually, after the delays and the requests for information, will come the next major event. The first offer. It will almost certainly be a lowball offer. It might even feel insulting. This is not an accident. It's a calculated psychological tactic called anchoring. They throw out a low number to set the starting point of the negotiation in their favor. They want to see how you'll react. If you get angry and emotional, they know they have the upper hand. If you seem desperate and immediately start negotiating up from their low number, they've already won. The goal of the first offer is to get you to question the value of your own claim. Your response should be calm, unemotional, and firm. You don't have to reject it on the spot. Simply say, Thank you for the offer. I will need to review it in detail along with all my documentation. I will get back to you in writing. This communicates that you are not going to be swayed by their anchor. You are operating based on facts and evidence, your medical bills, your lost wages, your repair estimates, not their opening bid. Woven into this entire process is another subtle but constant pressure: the attempt to assign partial fault. This is called comparative negligence, and it's a goldmine for insurance companies. In many states, if they can prove you were even 10% at fault for the accident, they can reduce your settlement by 10%. That glancing at the radio comment from your recorded statement? That's a potential 10%. A witness statement that says you were going 2 miles over the speed limit? That's another 15%. They will scour the police report, your statements, and witness interviews for any shred of evidence that suggests you weren't a perfect driver. Their goal is to chip away at the total value of your claim, percentage point by percentage point. Understanding these tactics, the friendly rapport, the recorded statement trap, the strategic delays, the lowball anchor, and the comparative negligence game, is like being handed the enemy's battle plans before the fight even starts. It transforms you from a victim of the process into an active participant. You're no longer just reacting to their moves, you're anticipating them. You're controlling the flow of information, you're documenting everything, and you're negotiating from a position of knowledge and strength, not fear and desperation. You've stopped playing their game and started forcing them to play yours. And this is the ultimate truth of the insurance world, especially in the non-standard market where companies like the General operate. It's not a partnership. It's a calculated, adversarial business transaction disguised as a safety net. Understanding this one single fact changes everything. It reframes every interaction, every policy document, every phone call. You stop seeing them as your protector and start seeing them for what they are: a financial institution whose primary fiduciary duty is to their shareholders, not to you. Their goal is to collect the maximum amount of premiums while paying out the minimum amount in claims. It's not personal. It's just math. Your policy isn't a promise of help. It's a contract. A very specific, very detailed, and often very confusing contract that they wrote with teams of lawyers to protect their interests. Your job, as the other party in that contract, is to understand your rights and obligations and to hold them to theirs. That's the game. So let's pull back the curtain on the entire business model, because this is the key that unlocks it all. Insurance companies, particularly ones like the General, make money in 2 primary ways. The first is obvious: underwriting profit. That's the difference between the premiums they collect and the claims they pay out. If they collect $1 billion in premiums and pay out $900 million in claims and expenses, they've made $100 million in underwriting profit. This is why they are so meticulous about risk assessment. It's why a DUI, a bad credit score, or living in a certain zip code dramatically increases your rate. They are betting on the statistical likelihood that you won't cost them more than you pay. But here's the second and arguably more powerful way they make money. It's called investment income from the float. The float is the massive pile of cash they hold, made up of all the premiums collected from millions of policyholders, that has not yet been paid out in claims. They don't just let this money sit in a vault. They invest it. They invest it in stocks, bonds, real estate, a vast portfolio of assets that generates enormous returns. The legendary investor Warren Buffett built his entire Berkshire Hathaway empire on the back of the insurance float from companies like Geico. Think about it. You pay your premium on the first of the month. They have your money immediately. If you have a claim, it could be weeks, months, even years before they pay it out. In that time, your money isn't just sitting there. It's working for them 24/7, earning interest and returns. This is why there is a built-in systemic incentive for them to delay, deny, and underpay claims. Every day they hold on to that money is another day it's earning for their bottom line. It's not necessarily malicious. It's just the fundamental mechanics of their business model. When you file a claim, you are making a direct withdrawal from the engine of their profitability, and they will protect that engine at all costs. This is why a company like the General, which deals with high-risk drivers, must be exceptionally good at managing this balance. They take on clients who are statistically more likely to have claims. To offset that risk, they have to charge higher premiums and be incredibly disciplined, even ruthless, in their claims process. They can't afford to be generous. Their survival depends on it. So what does this mean for you, the consumer, the person who just needs to get their car fixed and get back to work? It means you have to fundamentally shift your perspective. You are not a member of a club. You are a customer buying a product. And like any complex, expensive product, you need to understand it inside and out before you buy, and you need to know how to enforce the warranty when it breaks. This brings us to the final and most important takeaway of this entire series. Whether you choose the General or Progressive or State Farm, or some small local company, you must become an empowered, educated consumer of insurance. The era of blindly trusting a brand or an agent is over. You have to take ownership. Here's how you do it. This is your new playbook. First, you must read your policy. I know it's boring, it's dense, it's filled with legalese, but it is the single most important document in your relationship with your insurer. You need to know what is covered, what is excluded, what your duties are after a loss, and what the limits of your coverage are. Pay special attention to the exclusions section. That's where they hide all the gotchas. Don't wait until after an accident to find out that your custom rims or your rideshare driving aren't covered. Read it, highlight it, and ask questions until you understand it. If an agent tells you don't worry, you're covered, your response should be, show me where it says that in the policy. Second, the lowest price is almost never the best value. We're conditioned to shop for insurance like we shop for gasoline, find the cheapest pump. But it's not a commodity. It's a promise of future performance. A policy from a cut-rate insurer that fights you tooth and nail on a legitimate claim is infinitely more expensive than a policy that costs $20 more a month but pays without a hassle. Look at more than just the price. Look at their financial strength ratings from companies like AM Best. Look at their customer satisfaction scores from J.D. Power. Look at their complaint ratios on the National Association of Insurance Commissioners website. Do your homework. A cheap price tag can often be a red flag for poor service. Third, document everything. Always. From the very first sales call to the final claims payment. Get everything in writing. If you have a phone conversation, send a follow-up email summarizing what was discussed, and ask them to confirm its accuracy. Dear John, just to confirm our conversation a few minutes ago, you stated that my rental coverage is $50 per day for 30 days. Please let me know if my understanding is incorrect. This creates a paper trail. It moves the conversation from a he said, she said scenario to a documented record of facts. Save every email, every letter, every photo, every receipt. In a dispute, the person with the best documentation wins. Fourth, never accept the first offer, especially on a major claim. The first offer is almost always a lowball offer. It's a test. They're seeing if you know what your claim is actually worth and if you're willing to fight for it. They expect you to negotiate. Do your own research. Get your own estimates. Understand the value of your vehicle or the cost of your medical bills. Present your evidence calmly and professionally. Remember, you're not asking for a favor. You are demanding they fulfill their contractual obligation. And finally, number 5, understand your leverage. Your greatest leverage is the threat of litigation and official complaints. You don't have to scream or yell. You simply have to demonstrate that you know your rights and are prepared to escalate the situation. Phrases like, I'm not satisfied with this offer and will be consulting with legal counsel. Or please provide the name and address of your company's registered agent for service of process. Or, I will be filing a formal complaint with the State Department of Insurance, have a remarkable effect. It signals that you are no longer an easy problem to be dismissed. You have become a potentially expensive and time-consuming problem that it is now in their financial best interest to resolve fairly. This is the ultimate perspective shift. The General and every other insurance company is a business. By understanding their business model, their motivations, and the rules of the game, you stop being a pawn and you become a player. You can now navigate this complex world with confidence. You can choose the right policy for the right reasons, manage your relationship with them effectively, and if the worst happens, you can advocate for yourself with knowledge and strength. You are no longer just buying car insurance. You are making a strategic financial decision to protect your assets, and you are now equipped to ensure that the company you pay to do that job actually does it when the time comes. You have the knowledge. You have the playbook. The power is back in your hands.